Welcome back to Driving Deals, the podcast where we talk about what's really happening in dealership buy-sells and what it means for you as a dealer. I'm Gerrick Wilkins, CEO of Omega Advisors, and today we're recording live from the Omega booth here at the NADA show in Las Vegas. If you hear a little bit of show floor energy in the background, that's because that's a lot of what's going on this week, and that's exactly why today's topic matters. Today, I'm joined by John Paul Davis, one of the partners at HHM. John Paul, thanks for doing this live with us today. Appreciate you being here.
Absolutely. Excited to do it and happy to participate.
So, John, tell us a little bit what our partners may not know about who HHM is, what you guys do, and how you focus on automotive.
Sure. Absolutely. No, thanks, Jarek. HHM, we're a full service accounting firm. We work with our clients on taxes, any kind of tax compliance, tax strategy they need, any level of financial statements, whether that's audit, review, mainly for banking, that type of thing. And then also on advisory work. So we do a lot of transaction support, valuations, litigation support. Our largest niche is dealership. One of the things that we know is this industry is you got to be specific, right? If you don't know it, it's not a good fit, right? So we work with our dealer clients specifically on tax planning for dealerships and how to grow, how to expand, and then also just stay in compliance, right?
Absolutely. Well, I love having accounting experts on because dealers sometimes think, oh, this is my attorney's lane, or oh, this is my broker's lane. But the reality is accounting firms are often the ones that determine whether a deal actually works economically and after tax.
You know, it's a good point, right? Because the accounting lane is a little bit bigger than you think about it, right? But then at the same time, for us, it's really important that we're just involved earlier in conversations with the attorneys, the bankers, just so we add that little nuance of either tax planning or just maximizing value just through accounting, right? So for us, it's really participating with the overall team, but then also adding value within the lane of accounting specifically.
Oh, that's great. That's great. Well, before we get too deep into the woods, I do want to remind everyone that today's discussion is educational. We are not offering tax or legal advice. Every situation is different. So please consult your own advisors accordingly. And I think we have a nice disclaimer on the YouTube version going out right now as well.
Awesome. Thanks, Jarek.
So let's start with the basics because at the end of the day, that's where confusion can often happen. So when a dealer is selling or buying,
Right.
what should they expect their accounting firm to actually do during that process?
Yeah, a great question. I mean, you know, and you've got to be very specific, right? Because buying's very different than selling, and so you've got to change the hat a little bit in the approach. But at the end of the day, what are you buying? What are you selling? It's cash flows, right? And so just really diving in and looking at the trailing 12 specifically, knowing what your earnings are, knowing where your add back should be, being ready to defend those add backs specifically if you're working to provide just basically information around the opportunity that you're either selling or buying, and then also taking a step back and considering the structure. How are we going to finance this? Is it your money? Is it the bank's money? What's that effect of the financing on working capital? You could get into the weeds of I'm going to use the captive for my floor plan financing, but I'm going to use another bank for my cap debt. And you've got to think through the inter-creditor agreement and how you're going to propose that, present it. What we do is we'll help with the application process from the OEM from start to finish, right? So we can write the business plan, we can do the projections, work with you on the opening balance sheet, source of funds, how to present it to the manufacturer, how to present it to the banks. But overall, it's just taking a step back. What am I selling? Cash flow. What am I buying? Same thing. What's the opportunity? Then how am I going to present that?
That's really interesting. And we found that one of the big challenges is that normalized earnings. So tell us a little bit about how you guys really identify some of those components, because a seller, they put everything but the kitchen sink in there when they're trying to do add backs. And as a buyer, they're
Yeah.
trying to determine what is real and what's going to transfer moving forward.
Yeah. And so, and you're right, especially on the approach side of it, you've got to consider what you're doing, like the stickiness of the add back. A couple examples, like for instance, things that make it harder to determine the normalized earnings. Sometimes you have a management company that has shared services. How are those allocated, right? How's the corporate controller, how's the cost of that allocated? How is that being paid? A lot of times, your starting point is, oh, we're just going to add back the management fee, and that's a fair add back. Well, is it completely, right? Because if they're receiving services for the management fee or a portion of the management fee, then there's some validity to that expense. You really need to think about it in the context of how would this store operate standalone? What would it need to support its operations and activities? And then in the back of your mind, look to the synergies of, okay, well, what do I have within my organization and group that I can find some synergies, which is just additional value to me, right? Um, it's been harder on the normalization simply because of COVID. I mean, like margins, we've seen margin compression through 23 to 25, expecting that to normalize a little bit. Now there's discussion around tariffs, how that's going to change.
Sure.
So really what you're doing is when you're looking at the historic period and you're looking at normalization, you're trying to come up with a projection for what will the store do later. So you've got to always keep that in mind. It's not just what did the historic periods do, but how will that help you determine what it will continue to do going forward.
That's a great point, and that's something that we often tell our client buyers when they're looking at stuff. I said historical is only important in as much as it helps us determine what those future cash flows are
That's
going to
right.
be, because that's
Right.
what you're really paying for in a transaction.
Exactly. And I like to make sure that it operates standalone. So I just know my baseline, right? If I'm just buying this store, what can I expect? And then in the back of my mind, I'm also thinking, okay, well, what value synergistically do I bring because I have either a platform or existing shared office, that type of thing.
Yeah. So let's talk about what a lot of people think when they think of accounting firms as, oh, I'm going to call my accountant. He's going to tell me all the reasons why I can't do a deal. Is that how you guys take the approach, or how do you guys look at it when you're building?
No, I mean, listen, when a client calls me, I tend to get a little excited. So I've got to sort of pull back and question and look at the deal. But at the end of the day, we want to grow with our clients. We want to help them grow, achieve their goals. So a lot of it's looking at, well, if the store's not performing well, then maybe why? Is it an expense structure? So we'll dive into some benchmarking, either benchmarking to their existing stores or other stores that we know of or good examples of high performers to give an idea of what's the true opportunity.
That's a great point. Well, let me ask you along those same lines about rent factors and what you're seeing and the normalization process, because I always enjoy debating what's the right cap rate, and we know it's changed because of interest rates too.
I love that question because that's one of the things I've been thinking about in terms of the difficulties currently for transactions. And a lot of that revolves around real estate, right? You've got additional cost for construction tailing off of COVID, where that's sort of the normal math that you went into what you need to build a facility completely changed. Some of that's coming back a little bit back to normal. Disconnect between the cost to build a building versus what it will appraise for. It's been very interesting. We've seen some large appraisals come back, and they're not even meeting the level of what they needed to, or what the dealer just paid to build the building, which kind of seems counterintuitive. And then rates, right? So typically when we look at, all right, well, what's rent gonna be? Well, it's gonna be at least debt service, right?
Right.
And with interest rate changes, not a lot of movement there recently. That need for additional rent to pay for the debt service pushes the cap rate up when you're considering what your rent is. But your cost of capital is not necessarily the market value of rent. So you've got a little bit of I guess a little puzzle to think through. A lot of times you might not have as much rent expensed on the earnings analysis for the dealership, but you're going to have more rent because your debt structure is going to call for a higher amount of rent to pay for the debt service.
Well, and that's a great segue as we're talking through this debt component and how we're seeing financing. What are you guys seeing from the financial standpoint? Is there still ready capital available for deals out there, or?
I'd say it's a little bit of a bifurcation of the credit environment almost, where there's still ready capital. There are still banks, captives, traditional banks, banks that don't do floor plan, but will still lend on blue sky. There's still an appetite there, but the difference that we're seeing is the willingness to lend on an opportunity or a turnaround is not necessarily there. And that could be just the opportunity to buy a store that's underperforming but will perform better in a larger group, or for your first time dealers. or the dealer that just recently bought a store is looking to add another store. The conversations around that are harder. Um, so it is important if you're going to go into growth mode, think about conserving your EBITDA as a group because that's what will leverage you into those opportunistic purchases.
Which is amazing to see an accountant talk through some of this stuff because from what I've seen, you guys really get much more into these deals than just offering tax advice. You look at a true strategic partnership and talk about structure and the
Right.
capital side of things, and it's encouraging to hear that from an accounting firm that's
I
working through
appreciate
that.
that. We really view it as being part of the team, right? We're part of the buy side team or the sell side team. Part of the, we don't want to be that commodity of compliance. We're looking to be a business partner, and we're seeing a lot of deals. We know what to propose when it comes to language specific to accounting or tax, and how to structure it, how to think through the process. Like where do you want to be? If you're talking to a dealer, are we looking to grow by 10 stores in 5 years, so on? So I appreciate you saying that because it is different. We don't really, if you hear from your accountant once a year, you probably have a commodity relationship, where we want to work with our clients, work with our dealers throughout the year, add value, not just at year end, but as they're growing and as they're making pretty big financial decisions.
Well, that's great. So we know you've seen a lot of deals and you've worked through a lot of these. So why don't you tell us a little bit about what you're seeing as silent risks, things that can kill a deal that aren't in the headline price but can create real friction
Yeah.
even late in the process.
Well, I'll lean into my accounting profession and start with, the first is just poor financials, right? If I get a dealer statement, or if a client of mine who's looking to buy gets a dealer statement, and there's $1 million of prepaids, I mean, it's just an obvious question you're going to ask. And then behind that, just simple things like, have you gone through and looked at your depreciation schedule? There's a lot of deals. The purchase for fixed assets is based on net book value. The 2001 Dell Optiplex still on the depreciation schedule. What are we doing? Like, so we've got, granted, this probably fully depreciated, but it's just creating noise.
Sure.
So I'd say really good financials where you're actually preparing and looking at it. Something I've been debating is also, it's one thing to have financials with a lot of add backs. As a starting point, I'd rather have the add backs sort of baked in already. Like maybe, for instance, your over remits are going to the dealer or they're going to the management company, but they're specific for the store. And should those over remits be part of the F&I income for the store? Absolutely. But if I have it as an add back, I'm going to question it. Whereas if it's already running through the dealer statement, it's already baked in, so it's a little bit more approachable. So that's one. I would just say the financials. The other one, and this is a big one because I've seen it derail some transactions. Is it just a simple customer retention program? Maybe not. Maybe one that you're just running yourself, and it's oil for life or tires for life, something like that. And you don't have it accrued. You don't have a formal program. You kind of do. You kind of don't. You rolled it out some years ago. If in the due diligence we find a customer retention program, it's that can add time to the due diligence period. It adds a lot of discussion because what you're asking someone to do, especially on the buy side, is to step into that liability. So then the question is, well, what is it? And what are the details? So that can be a silent risk. And then lastly, just things like, when's the last time you did a parts count? You know,
Yeah.
do you know your aged inventory, your obsolete inventory? It's funny the amount of transactions we're at closing. The selling dealer says, "Well, all this is returnable. Hasn't sold in 2 years, but it's returnable. You can do a big return the day after closing," which technically might be correct, but there's not a manufacturer that's going to accept hundreds of thousands of dollars of parts the day with a new dealer code, right? So just getting through that and returning it yourself, working through that, because if it's returnable on your current dealer code, go ahead and do it and prepare and just maximize the value for yourself on the exit. And then, little things like payroll, or state nexus. I was working on a deal in New York, and the entire F&I department was paid on a 1099, even though they're employees. So that was an interesting one to work through.
Wow.
But I mean, those are the things where when you find them in due diligence, you're kind of hitting the pause button and you have a more in-depth conversation.
Well, it's interesting when you talk about some of the retention programs and that unknown liability, because you guys can work through and quantify anything with enough information, but then do you want to end up having to go through the process of a retrade in the middle of an APA at that point?
Right, right.
So
I've had more than once where the day of closing, we're negotiating what amount of credit we're going to get because we're assuming that customer lifetime retention program.
yeah. So it's important for our dealers out here who are listening or watching for you to make note of this, and that's why you've got to have good partners in the whole process, whether that's your buy-side advisors, your attorneys, or the accounting firms, because they can definitely help save you oftentimes hundreds of thousands, and in some cases millions in the long run. So it's great to have that. So John Paul, we know you're involved in transactions all over the place. So let's change places, change directions a minute, and let's talk about some of the trends that you're seeing. Since you've got that front row seat, what are you seeing with the transactions that are happening right now?
We've touched on a few of these items already, but the biggest trends that I'm seeing are one related to real estate. There's that big push for EV installations, which is now coming back, but still the construction cost, image compliance, working through, well, if I'm buying a dealership and I know I have to upgrade the facility for image compliance purposes, do I get a credit? Or does the seller maintain that value even though the building itself may not be image compliant? So that's something as a trend I think is becoming even more important. I'd say the new approach to earnings. We've had so much volatility within the past 5 years with COVID and what are earnings, what's the normal amount of profitability you should have front end, back end, and seeing expenses being a little bit all over the place. One of the things I'm seeing is looking at revenue and a net to sales revenue based on either domestic or imports or luxury, and backing into a new normal of revenue's higher, right? Costs of vehicles are all-time high. So if the revenue is going to be higher, there's essentially a new net to sales, and then you bake in what your capital or expense structure is, versus what we used to do is just really start with net income, do our add backs, and then focus on the earnings. We're starting to look same traditional direction, but then couching that within just a look at revenue.
Yeah.
And to kind of give you another data point, right? So that's been interesting. And then the last thing is just right now, just some uncertainty around financing. It's much easier to get financing if you have a really good bank account in the background, a lot of unencumbered assets on your personal financial statement. Basically, it's easy to borrow if you don't need it.
When you
Right?
don't need it, they always
Yeah.
want to give it to you. That's
Yeah.
right.
So I would say if you're looking at buying an opportunity, something that's a turnaround, or you spread a little thin, and you've got an acquisition makes a lot of sense. It's going to add a tremendous amount of value, but the margins are tight. That's where it helps to really work through and work with an advisor, work with your broker, and talk about how you're going to present that to the bank, how you're going to present it to the OEM, and that way you get the right partners to the table.
So you're definitely seeing some of the shifts in the quality of earnings and how people are looking at that, and what we're seeing from a net to sales standpoint. You guys you have cautions when you see a high net to sales number
Absolutely.
in relation to earnings?
Oh yeah. Well, I mean, you start about looking at it just from a benchmarking context and what we've seen. I mean, I've been with HHM for 18 years. Uh, um, Several of my partners have been doing transaction work for 30 years plus. And so we've got a good background of just what we've seen day to day working through these transactions, and then also working with our clients and seeing what it sort of like a broad basis net to sales is based on brand, based on location, based on market. You already go in with that institutional knowledge, right? Which is a little bit of a difference maker as to when you're looking for the right advisor. Do they have to do their homework or do they just know it? And then on top of that, just doing some more research, some analysis. And if I see it, to your point, if it's just like 10% net to sales on a domestic store,
Yeah.
I want to know a little bit more. I'm probably thinking there's some shared expenses that are at a management company, or maybe they're not treating the reinsurance add back correctly. So yeah, absolutely, you'd look at it. But you look at the inverse as well, right? If you it's funny, you're buying earnings, right? But
Sure.
if you have a store that's losing money, it doesn't sell for zero blue,
Yeah, they don't pay
right?
you to buy it.
No, they don't pay you to buy it either. So you do it in both directions, and you're really looking for just that equilibrium number. Now, of course, you know, you push harder in different directions depending on what side you're on, because we're trying to maximize value for our clients. But at the end of the day, coming to what is a reasonable, fair market number is the goal.
Yeah. That's great points. That's great. What are you seeing with CapEx planning and how that impacts the overall deal?
Yeah, you get into it, and especially like special tools or just manufacturer required CapEx. You're kind of looking at. I like to look at what do they have already. I like to look at the depreciation schedule, look at the aging on the items. I like to ask about their capitalization policy. Maybe they're just maybe the tools on the depreciation schedule are old simply because they've been expensing it, right? That doesn't mean it's bad. But just getting a better idea around that and planning within it. Typically, depreciation CapEx kind of align, but not always, right? What if your dealer statements are on tax basis and you don't have depreciation because you took bonus last year?
Right.
So you've got to think through that and plan around it. And it really just comes back to, all right, what earnings am I buying? How much cash am I going to have to invest to maintain the assets that then generate that cash flow, right? And plan for it.
Great point. All right, well, let's change gears again and let's talk a little bit about one of the most misunderstood areas, working capital. Dealers hear it, but they don't always understand how it becomes a negotiation point where the OEMs are coming up with guidelines and how they need to plan for that accordingly.
Yeah. And you're right. I think it's both simple and yet it's pretty complicated, right? So if you think about it, your working capital when you first buy a store, okay, is going to be the vehicle equity that you purchase from the selling dealer, okay? It's going to be your parts inventory that you're buying, and it's going to be the cash that you put in the store day one to operate. That's your working capital. Gets a little complicated after that because you got payables and then receivables, and that all adds to the mix. But
Debt-owned used cars.
yeah, yeah. Are you treating your rentals as short term or are they long term assets? That type thing. But for the most part, it's cash, it's vehicle equity, and it's parts day one, right? And a couple nuances, right? The manufacturer has the requirements. They're going to give you your required working capital either based on your projection or a number they give you from the very beginning of your discussions. And so it's really important if the working capital is based on your projections, come up with a reasonable projection because that's going to drive the requirement up or down. Same time, you want to find out, it's a good idea to stress test that calculation to know if you overperform year one, what amount of that profitability and that cash flow do you need to retain in the dealership to meet what will be your new requirement, right? So for the most part, you're buying the assets. You're going to buy the blue sky directly. You're going to buy working capital in terms of the vehicle equity and the parts, and then you're bringing your own cash to the table. So there's less negotiation with the seller because you're really just negotiating with the OEM as to what they want to see for your opening investment. But there are certain times you get into a reorganization and maybe a stock transaction, and maybe you're going to sell an ownership chunk, and you really do start looking at your working capital because maybe you've built up your balance sheet and it's just undistributed earnings and you can take it out. The dealership can continue to operate, no problem. But maybe you might need to retain more so it continues to operate at a high level. So there are discussion points. Here's the way I look at it, right? Let's simplify all that word salad, if you will. The lowest point is the manufacturer requirement.
Yeah.
Fair? Typically, a high-performing dealer will need more than the manufacturer requirement to continue to operate at a high level. Okay? And then the question is, well, what is that? So you look at the trailing 12, you look at the past 3 years, you look at it as, a percentage of revenue, percentage of, or a multiple of your cash flows. and you get to a point where you're probably going to be between what's on the balance sheet and what the manufacturer requires.
Oh. Yeah, it's interesting. When you sell more cars, you need more money to do so,
Yeah.
even when
Yeah.
you're performing. It's a crazy concept, but
Yeah.
so good problems to have for those dealers doing well. Well, let's change gears again and start talking a little bit about some tax planning strategies and what that may look like. We see this all the time. Two offers can be close on price, but very different after tax. So from a seller's perspective,
Mhm.
what are the biggest tax planning levers, and what can they do to help protect themselves from a tax standpoint?
Absolutely. First thing is structure analysis, right? If you're selling ownership interest or you're selling assets, it behaves differently if you're an LLC taxed as a partnership, if you're a corporation that made an S election, or if you're a corporation. So knowing your structure and knowing the effect of how that's going to work from a tax perspective is really important. Like, for instance, I'll give you an example. If I sell 100% of my S corporation, I'm just going to pay long-term capital gains as long as I've held it for a year and a day, right? Conversely, do the same thing, but me and my partner sell my LLC or our LLC, right, for the same dollar amount, and we sell the member units. Same concept, right? I'm looking at ownership interests. Well, if I do that, um, all of a sudden I have to contend with hot assets, and I've got to drill down to the underlying assets to calculate. Well, maybe I have depreciation recapture. That's a higher tax rate. Maybe, so thinking through that, step one, right? Structure analysis. I'm going to throw a weird one out. From time to time, you should consider personal goodwill. If your name's on the building, customers have your cell phone number, and especially if you're a C corporation or a corporation, it's fair to do that analysis and consider personal goodwill. And I'll give you an example why, right? So let's say you've got that C corp and you sell the assets. Then you're going to pay 21% on the asset sale. And you're going to pay 23.8% when you take the money out, when you liquidate the company, right? Well, if I carve out an amount, which is, based on an appraisal, based on a valuation, that's fair, defensible, and I align a portion of the blue to personal goodwill, then I really only have one layer of tax. And it's at the personal level, my long-term capital gains. So anyway, so thinking through that could be a good one. I like to. You've also got to consider the underlying allocations as well, right? I've seen time and time again where they've got one number for fixed and blue sky, and they're thinking this is great. Thinking, okay, those behave very differently, right? Like the tax is going to be very different, and what's generally in all things, right? What's good for one side of the transaction is bad for the other side of the transaction, and in tax, if someone gets a tax win, that's because someone else is getting a tax loss. It's typically how that works. So thinking through the allocation between blue sky and fixed assets, that's important. Thinking through the structure analysis and what can we do to mitigate tax.
Man, that's some great advice that we've talked about and some basic planning. But at the end of the day, it sounds like this is why it is so critical for our dealers to have true partners that understand how this works on both a tax and legal standpoint from there. So now let's flip this around. We talked how sellers can plan, but for buyers, especially groups trying to grow, and we see that they start looking at tax strategies or planning angles. Are you seeing that they're making things more competitive? Are they doing some things differently as well?
Yeah, I mean, you're just on the other side of the coin, right? So and one thing that I would stress heavily with the buyer is start thinking about your estate planning from the very beginning, right? Even if you're 30 years from your hoped for retirement, you know what I mean?
Yeah.
So when you're going into a store, if you can consider having a portion of your ownership in a trust that aligns with your overall estate plan, that's possibly one of the best times to maximize value growing outside of your estate, right? And so thinking through that, and I think our more sophisticated dealer groups are looking at that. They're looking at value to the overall organization. What's the structure going in? And they're thinking about their exit as well. So those conversations on the front end can save you a tremendous amount on the back end.
Well, it's interesting that you talked about the trust standpoint. We had just an earlier episode, we had the president of National Christian Foundation talking about donor advised funds and
Right.
how people who are philanthropic in mindset could amplify their giving just by allocating a portion of shares to that donor advised fund. And
That's
whether you're
right.
giving it before tax or after tax, we know there could be a huge difference.
I'm a big fan of donor advised funds. Those are a great way to get the contribution, but still maintain a little bit of that, not necessarily, I don't want to say control, but input guidance on what the what those donated dollars do, following your personal mission or organizations you want to support.
So we're covering a lot of ground today. So let's keep things moving and transition again, and let's talk about some more about the people paying. What are the most common mistakes you see with sellers make, and the common mistakes that you see buyers make when they're going through these transactions?
Yeah, I'll start off, and I know we're harping on estate planning, but one, common mistake sellers, they think of estate planning as they're going to close, right? That's not the right time. That needed to happen a little bit in the past, right? Your books don't support the earnings or the add-backs. Preparation beforehand will help tremendously. Um, that stickiness of the trailing 12, even if you just corrected the issues in the past 12 months, that helps. It really does. So thinking ahead of that and doing it in advance, reviewing your schedules. Look at your schedules. Make sure you don't have anything that you're not actually realizing value. Like for instance, I've got some dealers that leave some profitability on the balance sheet. They don't bring it into the 13-month. But if you're in a buy sell and you're giving the dealer statement to support the earnings of the store mid-year,
Yeah.
you should think through that, right?
Yeah.
So just coordinating. I'd say, one of the other items is just not having the team, right? You've got to have industry specific legal counsel, broker, financial advisor, insurance, and accounting. And if you've got all of that built together with you, and I might have left someone off, and if I did, I apologize. I'm not trying to, but
We'll put John Paul's number up there so you can
yeah,
call him and complain later.
thanks. But the fact is, it's like the team, right? Have the team, make sure that they know what they're doing, that they've done this before, that they have the institutional knowledge, the industry knowledge, um, and that typically can solve for a lot of these items, right? Because the team's going to help remind you about it. Our dealers don't need to be estate tax planning specialists, right? We don't need to be tax accountants. That's why we're on the team. Same thing about legal docs, the whole thing.
Well, that's good. And we alluded to some of this about preparation, but let's make this practical. So let's talk
Yeah.
to a dealer who's thinking about selling in the next 12 to 24 months. What are some practical things that they should start doing today to prepare for that?
First thing would be, I like to just start building out a packet that essentially mimics or mirrors the opportunity that you're going to present, right? And finding ways to bake in the add backs without hurting. There's no reason to pay additional tax, right? When I'm not trying to do that. Pay more tax so you can sell your dealership for more, right? But it's just the groundwork of preparing for, okay, where's the value, where's the earnings, where's the cash flow, and can we make our statements and our documentation provide support that gives a buyer more comfort? So number one. Two, look at the tax structure. Did you make an election? Is there an opportunity um, to maximize the end dollar or the net dollar to the dealer simply through tax structure and organization? So I'd look at that. I'm sure I'm missing something, but that'd be a good start.
Well, good. Well, I appreciate that. And let's, as we're starting to wrap up, let's go into what I like to call our lightning round. So these are just quick answers, going to hit
All
you
right. All right.
hard and fast and see what you got. One metric: buyers are watching more closely now than ever.
I'd say your cap rate on your real estate.
That's a fun one. Yes. One diligence item that always takes longer than people expect.
You're gonna think I have this on my mind just forever, right? The customer retention program. I'm telling you, if those are in there, it just takes longer. And the amount of time I have clients like, why aren't you done with this report? Like, I need a lot more now.
So for those of you dealers listening or watching, make sure you're checking those customer retention programs.
Yeah.
It's the one big great
That's what
takeaway
I'll be
today.
known for right after this. That's the guy that hates customer retention programs. It's awesome.
All right, one tax planning conversation every dealer should have annually.
Just have one. Just have the tax planning conversation because it changes a lot, right? You've got different elections that you could do, and sometimes it's just a continuation of what you're doing. You're already on LIFO, so you need to make your LIFO estimate. But it could be as simple as you bought real estate, and if you tell someone after the fact, I mean, you got to have time to prepare for the cost segregation study. So just what I would say is there's not just one topic or item that you should talk about every year. You should just have a tax planning meeting every year.
Yeah, great advice. One red flag that makes you say, slow down.
I'll speak about it from my end, right? So if I,
Can't be customer retention.
it's not, I promise. But I would say combativeness during the due diligence period. And here's the thing. I mean, I get it. It's invasive. It's frustrating, especially if you're asking the controllers who are busy. They are slammed to take extra time to give documentation to someone who's just going to review it and ask a bunch more questions, right? But if ever I get a lot of pushback or just no, you don't need that, or no, we're not going to give you access to that, I immediately start wondering why. And then I want more information. So I think if there's a red flag, it's just that combativeness at the very beginning. Sometimes it's just personality, and I get it, but sometimes it's because there's a reason.
That's great. Well, I've got one last question for you today as we wrap up. What do you wish more dealers understood about the role an accounting firm plays in making a deal smoother and more profitable?
So our role is simply to be a part of the team that makes everything run smoother and create better value and retain value, right? So, and I know you probably wanted a very simple and concise answer, and I gave you a big one. Tried to touch on everything, but here's the thing. So, what I like to do is I really like accounting. I like the numbers. I like to dive into financials, and I want to help my dealer clients do what they love best: empire build, sell cars, meet with their customers, and the rest. So while they're doing that, having a good, competent, proactive, not reactive, but proactive CPA that's going to engage and offer advice and bring solutions to the table from the front end just allows them to run with what they love doing and to do it better.
Well, this has been an outstanding section. John Paul, thank you so much for joining us. John Paul Davis with HHM. If you didn't get a chance to connect with us or them during the NADA show, make sure you reach out afterwards. We'd love to schedule a strategy conversation, and I'm sure you would be happy to do the same.
Be happy to. Thanks, Gerrick.
Thank you all. Have a great day and enjoy your time driving more deals.